Hey guys, let's talk about market predictions because the most common question I get from you guys in the comment section is something like, hey Chris, what do you think the price of Bitcoin is going to do next? And in this video, I want to talk about the mental models that we can use to come up with predictions and why I think most people actually approach this from the wrong perspective. And to explain why I think that's the case, let's start with a quick story. And to catch you up, over the past couple of months, I've been slowly starting to accumulate more Bitcoin and a very select few other altcoins because we are late in the 5-phase market cycle that I've talked about in a lot of my prior videos. And to give you guys a little context for anybody that doesn't know, I do watch lists and trade alerts showing what my plans are, what my expectations are, and I even go so far as to show exactly where I get filled on orders and talk about my entry and my exit strategies. That way I can fully communicate my ideas to our community. And last week I actually recorded a video that I sent to my entire email list talking about Bitcoin when it was really curling up in this tight consolidation range, because as I've talked about in a lot of my prior videos, Bitcoin's kind of like a heartbeat. It goes through moments of contraction and expansion. And one thing that we notice is when price starts to squeeze really, really tight, either into a support or a resistance area, and the daily candles start to get really, really tight, that contraction leads to expansion. And so the video that I sent to my entire email list was basically talking about what those possible scenarios were. So I recorded that video in the evening and sent it to my team to edit, produce, and then schedule to email out the next morning. Well, what happened was overnight, Bitcoin actually broke out. And I had some limit orders waiting on exchanges, which I'll talk about more later in this video. But I had this funny comment on one of my prior YouTube videos where a guy was accusing me of recording that same video over and over and over and waiting for the breakout. That way I could somehow look smart, I guess, after the breakout happened, even though that wasn't a prediction video. But it got me thinking about the mental models that people use and think I use whenever we're looking at price, trying to figure out what's going to happen next. And my guess is that most people actually get this wrong, or at a bare minimum, completely misunderstand how I approach the markets. With that said, what is the best way to predict Bitcoin's price? Well, and to answer that, we have to define what price predictions really are. A prediction is just somebody's opinion where they try to guess what a market's price is going to do in the future. So an example of this is somebody saying I think insert market, I think Bitcoin, or I think this altcoin, or I think the stock market or gold or real estate or whatever is going to go to X price or increase or decrease by X% because of, and then insert reason, right? So one thing we'll see is on CNBC, they'll set up these fights, right? Where you'll have half of the screen, somebody who's like a Tesla bull, and they're going to give all their reasons why they think Tesla's stock price is going to go to the moon. And then on the other side of the screen, you'll have Tesla bears, where they're going to argue for all the reason that they think Bitcoin or Tesla's price is going to crash, right? So the problem with predictions, as we just defined it, as people's opinions about what they're guessing is going to happen, is they assume you know a whole bunch of stuff that you really don't. The first thing is you assume that you know what all market participants, meaning traders and investors, are going to do, when they're going to buy, when they're going to sell, if they're going to panic, right? Because at the end of the day, it's humans that actually drive prices up or down. And I'm going to link up one of my prior videos talking about what actually drives the price of different markets, because there's a whole lot of misconceptions behind that. But again, the problem with predictions is you assume that you know what everybody's going to do, where in some of the thinner markets or even big markets like Bitcoin, you can have one fat finger trader who does a market order buy or sell that can completely throw off what seems rational. It also assumes that you know what new market participants are going to come into the market and when they're going to do that, right? So it assumes that you know when new buyers are going to come into a market, which even if you're right, even if you think more buyers are going to come into a stock or a crypto or whatever asset, knowing how much and when is virtually impossible to know. It also assumes you know what fundamental events will have an impact on price and to what degree they'll affect price. And it also assumes that you know all the other stuff that can happen, like shifts in market sentiment, right? Like when people went from 2015, the media was just bearish on Bitcoin. Everybody was talking trash about it. And then at the height of the Bitcoin bubble in 2017, you had all these celebrities that were posting like Instagram pictures with, Bitcoin stuff, right? So you don't know how those shifts in market sentiment are going to change over time. Also, what new innovation is going to come up, and just random black swan events, meaning unknown events that just happen in the future. So an example of some of these like guesses or predictions is what we've seen in the news or in social media a lot recently, where people will try to pick a pie in the sky number for Bitcoin's valuation based on things like user adoption or the market capitalization of gold, right? Where they'll say, okay, there's only going to be 21 million Bitcoin and there's X number of millionaires in the world. Therefore, there's not enough Bitcoin to go around for every millionaire to own one Bitcoin. Therefore, the price needs to be X. Or another is, well, Bitcoin is a better digital gold, right? So the market cap of gold is 7 trillion. So therefore, if Bitcoin equals gold, it's going to be priced at X, right? And we see people making really long-term pie-in-the-sky predictions. And again, those are opinions based on incomplete information, right? We don't know how market participants are going to respond to that, what the fundamental or economic landscape is going to look like in the future. And so while I think those guesses or predictions can be interesting guides or interesting things to think about, I think it's really, really difficult, if not damn near impossible, to actually place your money on the line, meaning place trades or make investments in a disciplined way when thinking that far out, right? For me, my sweet spot is anywhere from a few weeks to a few months. Outside of that, especially in crypto, because it's such a fast changing space and it's evolving so quickly, we may vastly over or underestimate those longer term scenarios. So instead of trying to quite literally risk my capital based on longer term opinions or predictions like that, I want to do it in a much more disciplined and precise way that we'll talk about in a second. So now that we know the popular way that people try to predict prices is flawed in so many ways, is there a better way? Well, the good news is yes. In my opinion, there is a much better way, and I'm going to give you 5 steps that can hopefully make this easy for you to implement in your own investing or trading. And the first thing I want to talk about is a concept I learned in The War of Art, which in my opinion is a super valuable book for anybody who's an entrepreneur or creator or investor of any type. But one of the things he talks about in this book is the big mental difference between amateurs and professionals. And he goes into a lot of depth of what the differences are between the two, but I just want to bring this into what it looks like in the markets. So there is a massive difference between how amateurs and professionals approach their decision-making process of when to buy and sell. So let's first talk about what amateurs do. So the first thing amateurs will typically do is look for somebody to tell them what the markets are absolutely going to do. It could be somebody like me on YouTube, somebody on CNBC, but I'll just say this: if your only strategy to investing in any market is looking for somebody else to tell you what is absolutely going to happen, you're already starting from a losing position. The second thing amateurs will do is they'll try to use technical analysis, basically looking at price charts or their own opinion about a market to justify why the market has to do something, right? They'll say, well, this indicator lines up this way. That means it's guaranteed to happen, right? But professionals understand that technical analysis is not perfect. It's not 100%. And if you are relying on any single indicator or charting tool to tell you what's going to happen, you're going to be let down big time over time. Now, something else that will happen is they will buy or sell at a random price, hoping that the market goes in their favor. And the problem with that is what happens on the opposite side is if price moves against them, right? Like say somebody buys and then the price starts going down and they just bought at a random price with no reason behind it, they will be the first to panic sell, right? Again, at a random price. And that's why a lot of people, even though they know inherently you want to buy low and sell high, most people do the exact opposite and they don't realize it until it's too late. And then the final thing is they will fight with people that disagree with them. You'll see this on social media, in like crypto Twitter all the time. People that disagree with each other fighting over who's right, which doesn't do anybody any good. So now that we know what mistakes amateurs typically make, let's talk about the right way to do this, and specifically looking at the 5 steps that professionals use. The first step is you want to look at all of the possibilities, everything that the market could do. So the way that I like to do this is starting by looking at both a bull case and a bear case, meaning what would happen and what would this look like both on the chart and in the real world if price went up or if prices crashed. And you can do this no matter what the price of any market is. Just think about these scenarios. It's kind of like thinking like a chess player where you say, okay, what are all the possible outcomes? And you want to think of as many of them as you can. But to keep it simple, just come up with either a bull or a bear case. And then from there, once we kind of know all the possible outcomes, then we weigh the probabilities. So we say, based on the current information that we have, what's most likely to happen, right? And sometimes you'll have a lot of conviction and you'll say, based on all the information we have right now, I think there is an 80 or a 90% chance that this outcome is going to happen. Or, and this is probably 9 out of 10 days for me, is I don't see a significant edge on either side of the market. And after you look at all the possible outcomes and what you feel like is most likely to occur, then you create plans of action based on favorable scenarios. And a plan to action to me is something like, if price breaks this level, I'm going to enter here with a profit target of X and a stop of Y, right? So you know where your entry is going to be, where your profit target is, and where your stop, either a mental stop or an actual like market order that you place on an exchange. So if your favorable scenario or your plan does not play out, you know where to get out. Now, after you come up with those plans, step 4 is you enter a position if the market follows one of those plans. So you've predefined what a trigger for an entry would look like for you. You've predefined your target and your stop. And then very simply, if that occurs, you enter the investment or the trade. And the 5th step is where everything comes full circle, where you cut off the trade or the investment if it doesn't follow their plan. So for an example in Bitcoin, you say, okay, I'm going to enter on a break of this level with a target here and a stop here, and say it breaks out, but it's a fake out and then it falls. Instead of hoping that it recovers one day, you've predefined where your stop is going to be, and then you cut it off and you wait for the next favorable scenario. So now that we've covered the 5 steps, I want to show you a real world example of how we've applied this to Bitcoin recently. So going back to the beginning of March, I sent out a watch list on a couple of different markets. And basically what I said about Bitcoin here was I've been accumulating some Bitcoin in the 4K range, and we've had 4 touches of resistance. And I'm basically waiting for a scenario to buy a breakout above that resistance level. So a couple of weeks later, sent another watch list update basically saying watching the squeezing price action on Bitcoin. 4K is around emotional level, and I'm seeing, basically explaining market sentiment and kind of the fundamental landscape that I'm seeing. I don't have strong conviction here of direction because, again, when price is squeezing like this, I think this is a really dangerous time to try to predict what outcome is actually going to happen. So going back to the 5 steps, I look at all the possibilities, right? So the possibilities here are either a breakout of multi-month resistance, or if we snap this trend line, we're going to get a retest of multi-month support, right? So just by looking at that chart and starting by thinking about the possibilities first, it takes my mind away from trying to be right? Like if you're flipping a coin and you're like, man, I hope it lands on heads, why not allow yourself to get in a position or put yourself in a position where you can profit no matter what the outcome is, right? And that's where thinking about all the possibilities and then creating plans around those possibilities is so much better than trying to guess and hope that you're right. Right? I hope you see that distinction there. It's so important. So fast forward a few days, and once Bitcoin finally did break out, I sent a trade alert explaining what my plan of action was from there, right? So like I mentioned, the first thing that you think about when you're going through the investment or the trade process is step number 1 is the entry, right? Step number 2 is you plan your reward and your risk. So if we zoom in on this chart a little bit, one thing that I like to do on my charts is map out the reward to risk. So I look at my first profit target, right? It could go much further than that, but I just want to identify like where's that first area, and then also where is my stop zone. That way I know my max loss on a trade, and I've identified where I get out if that doesn't work. Where on the upside, if the trade does continue to work, I know the first place I'm going to take profit, and then we'll manage the trade from there. So to recap, I just want to talk about a few tips and tricks and final thoughts for you. And the first one is this: take on the professional's approach and mindset, or just don't trade or invest at all, right? Most people lose in the markets, right? Like something like 90-something% of people either underperform the markets or actually lose money over time. So to give yourself the biggest advantage, I would say take it seriously and approach it from that professional level, or at least that professional's mindset, or go do something else. Because at the end of the day, there's a lot of people that are taking this professional's approach. And if you don't, you're probably going to get your lunch taken by them. And the second is check your ego at the door. If you find yourself trying to be right or fight with others about your opinions about markets, that's only going to cost you in the long run. Also, create a plan or stay flat, right? So a lot of people think they have to buy or sell something to be active in the markets, but flat is a position too, meaning if you're paying attention to a market, but you don't have any orders open or you don't have any positions open, you can still be active and just say like, hey, right now, flat is the best position. I don't necessarily need to be long or short. Also, understand how to use different market orders for markets that trade 24/7 like Bitcoin. You know, one of the biggest challenges is we're human. We sleep, we travel, we have meetings, we do things that you're not going to be in front of the charts all the time, right? So you want to learn how to use orders that you place with the exchanges that can do the work for you if you're sleeping, right? So for example, like on this last Bitcoin trade, I only got filled because I had limit orders waiting. If I was trying to be awake for all of that, I would have missed that breakout. And then the final thing is planning for all possible outcomes is way greater and better than trying to guess what's going to happen much further out, right? And again, it's not about being right or wrong with long-term predictions. It's just about understanding the limitations and the things that are outside of our control that we just don't know that make long-term guesses, aka predictions, virtually impossible, right? So if you're gonna risk your money in crypto or stock market or anything else, Just learn to think like a professional and approach it from a methodical standpoint. And I think that's going to help a lot of people. So again, guys, I hope this video was helpful. If you have any questions, feel free to leave them below. Like it up or share it with a friend. And I will see you next time. Take care, guys.